Hello, welcome to this edition of TaxSnax. My name is Mary Ashley, and I'm a barrister practicing from Old Square Tax Chambers. If you would like further information on this talk, or if you would like advice in any other area of tax, please get in contact with my clerks. Their information can be found at taxchambers.com. Today, I will briefly cover the three different higher rates for stamp duty land tax, which are the 15% rate for high-value residential transactions, the 3% higher rates, which apply to purchases by non-individuals or to purchases of additional properties by individuals, and finally, the 2% surcharge for non-resident buyers. So let's get right into it. The first higher rate is the 15% rate of Sdlt for high-value residential transactions. This was introduced in Finance Act 2012. Its purpose was to discourage the enveloping of property and is ultimately just one of the means that the government has used to do so. For the higher rate to apply, the purchaser must be what HMRC coined a non-natural person. A non-natural person would include a company, a collective investment scheme, or where a purchase is made by or on behalf of the members of a partnership with one or more corporate partners. Where the non-natural person is the purchaser in a high-value residential property transaction, with a high-value property transaction being one with chargeable consideration higher than £500,000, then they are subject to the 15% higher rates. Now, there are numerous exclusions and reliefs available which resemble the reliefs which are available under ATED. Originally, this relief was limited to property developers, but this has since been extended to include, for example, property business relief, dwellings made available to the public, relief for farmhouses, and so on. If a relief is claimed for this higher rate, then care should be taken to avoid it being clawed back. Now, the second kind of higher rates are the 3% higher rates, which apply to purchases by non-individuals or to purchases of additional residential properties by individuals. The 3% higher rates have applied since 1st of April 2016, but they were significantly amended as from 22nd November 2017. The original purpose behind this legislation was to combat increasing house prices, which were seen at least in part to buy-to-let landlords and wealthy foreign investors. So the conditions for the higher rates to apply to any persons, that includes trusts and companies, are that first, the main subject matter of the transaction must consist of a major interest in a single dwelling. The chargeable consideration for this transaction must be £40,000 or more. And finally, on the effective date of the transaction, the new dwelling must not be subject to a lease with an unexpired term of more than 12 years. Now, where the purchaser is an individual, there are additional requirements for this charge to apply. First, at the end of the day on which the effective date of the transaction falls, the buyer must have a major interest in a dwelling other than the new dwelling. So basically, they must also own another house. And second, this new dwelling must not be a replacement for their only or main residence. In relation to these requirements, it is worth noting that a major interest in a foreign dwelling will count. Therefore, if a person owns property in France and is buying in England as well, unless they are replacing their main residence, they should expect the higher rates to apply. Additionally, the 3% surcharge will not apply to the acquisition of non-residential property or mixed-use property. However, if the property which is already owned is mixed-use and contains a dwelling, then it is still treated as ownership of a major interest in a dwelling, and so the higher rates could still apply to the purchase of the additional dwelling. Further to what I've already mentioned, I consider that there are a few further points worth noting about the operation of the legislation. First, spouses and civil partners are essentially only entitled to one main residence between them. If a transaction would be a higher rates transaction for one of them, it is treated as a higher rates transaction for both of them. Therefore, it is not possible to get around these rates through having one spouse own one residence and the other purchase the new property. There are exceptions to this, of course, in cases where, for example, the couple are legally separated. Second, it is important to keep good records and evidence in circumstances where multiple residences are already owned by the purchaser, and the purchaser will want to claim that they are replacing their main residence through the purchase of the new dwelling. There is not a nomination process to decide the main dwelling like there is for capital gains tax, so it will be important to be able to establish that it is the case through evidence, including For example, where they are registered for the doctor, where the kids go to school, where their cars are registered, etc. Third, the meaning of major interest and whether an undivided share in one is a, quote, major interest had been an issue of debate between practitioners. This question was put to rest, however, as the legislation has extended the meaning of major interest for the purposes of these higher rates to include an undivided share in a major interest. Fourth, where there are two or more purchasers, then if any of the purchasers come within the higher rates, all of the purchasers will have to pay the higher rates. And finally, where land is inherited, a person is not treated as having a major interest in it, where they become jointly entitled with one or more persons to a major interest in a dwelling, and the beneficial share in the interest does not exceed 50%. This treatment lasts for 3 years, beginning with the date of the inheritance, provided the inherited share does not exceed 50%. Now, before moving on, I want to briefly address two additional specific issues. First, it is important to consider how the legislation operates when the purchaser is a trustee. Where there is a settlement, then the beneficiary will be treated as the buyer for the purposes of establishing whether or not the higher rates apply to the transaction if the beneficiary is either entitled to occupy the dwelling for life, entitled to income earned in respect of the dwelling, or is the beneficiary of a bare trust. If the beneficiary in those circumstances does own a property already, then the higher rates will apply to the purchase by the trustee. Where the purchaser is a discretionary trust, the higher rates will automatically apply as it will not be an individual purchaser, so the requirement of an additional dwelling is not there. It is important to remember that even though the beneficiary may be treated as the buyer for the purposes of the application of the higher rates, the trustee will still be the official purchaser, and therefore it is the trustee who will be required to submit the land transaction return. And finally, the one last point before moving on, it is important to bear in mind the time limits for claiming a refund in circumstances where the previous main home is sold. If the property was sold on or after 29th October 2018, then a claim for the refund must be made within 12 months of the sale of the previous main residence or within 12 months of the filing date of the return relating to the new residence, whichever is later. It is important that these time limits are followed. It seems unlikely that it would be possible to claim for overpayment relief if a claim for this relief is not made in time. The last area I want to look at today is the higher rates that apply where the purchaser is non-UK resident. From 1st April 2021, non-UK residents that buy residential property in England and Northern Ireland will pay a 2% surcharge in addition to the Sdlt rates for residential property. The purpose behind this new additional rate is to help control house price inflation. Now, there is a specific residence test for the purposes of this rate. The basic test for individuals is that they are UK resident in relation to the chargeable transaction. They are present in the UK on at least 183 days during any continuous period of 365 days that falls within a period starting a year before the date of the transaction and ending a year later. Importantly, it does not run based on the tax years, and it is not the normal residential test that we would apply. Taxpayers will want to keep records of their residence and therefore of their travel and their time spent in the UK if they are concerned about meeting this test. There are further tests that apply for other types of purchasers, including, for example, companies or trustees, so the legislation should be consulted in those cases. There are no specific reliefs from this additional charge, though if any general Sdlt reliefs are available, it should be possible to claim those. I hope this was informative. Please remember to subscribe to our TaxSnax so you don't miss a future one. Thank you.